Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning guest on the show with us today is Mike Swanson. He's the publisher of WallStreetWindow.com. Mike, welcome back to the program.
Oh, it's great to talk with you.
I feel like every time we get on the call, we sound like broken records because we've been talking about the market being overpriced for some time, and gold stocks always seem cheaper than they should be. There has been some progress for sure in the gold sector since we first had you on well over a year and a half ago, but let's start with the area there has not been progress as far as we're concerned, which is the overvalued nature of the stock market and where you think that is right now.
Well, the past, actually, I think it's been some time since we've last talked, and November was really interesting for me because last year in the fall, in August and September, I started to short the stock market again, and we had a little bit of a decline into the Trump election, and then election day, everything just turned around, and I got out of those short positions. I actually went long, and I bought banks, I bought infrastructure stocks, transportation stocks, and we had a tremendous rally. And they were calling it the Trump rally back then. And look, I was looking at what his economic advisors were saying during his transition team. They wanted to lower taxes. They wanted to raise interest rates and really make changes that I think would be helpful for the U.S. economy. But I got to tell you, in February, I sold everything I bought based on those notions. Because, yeah, the stock market was overvalued. It was overvalued when I bought. But I thought, these changes could create new leadership in the stock market, new leadership groups that could keep the market up or drive it for more than just a couple months and, stimulate the U.S. economy, really get some things rolling that we haven't seen in such a long time. But I got to tell you, in February, I sold, and I really don't think Trump is going to lower taxes or get much of anything done on these fronts. And it's more like I know a lot of people voted for Trump, and honestly, I voted for Trump too, just so people know that. And I'm saying that to me because so many people that vote for Trump are like him. It's like a cult following, and they just believe anything he says. And he says they're going to do tax cuts. He tweeted that the other day, and I'm here to say, hey, I voted for him, but I don't believe it. And there's no evidence of any tax bill being created or anything. I just think he says things, and it's not reality. And it's not something like I'm just saying that as an opinion. Like I'm watching a baseball game and I'm rooting for a team. I'm not here to root for Democrats or something like that. I'm managing my money, and I've come to the conclusion it's not going to happen. So what that means for the stock market is we had a rally that was led by these so-called Trump sectors, and those sectors all peaked out in March, and they're just lagging the market. And now the new leadership is the same old fad tech stocks, the Apple, the Amazon, the Facebook, Nvidia, that we saw in 2015, and that's not. So I think we're entering a phase similar to the summer 2015 where those stocks are taking over and everything else is just floating around, and we're not in a new economy, new economic boom or anything. It's just like, here we go again, like 2 years ago. And just like 2 years ago, I think this is actually going to lead to another big drop like we had that August or in the first quarter of 2016, probably by the end of the year, because by August, if Trump does not pass tax cuts in any meaningful way, and I don't think he's going to, I think a lot of the people who believe in that are going to realize it's not true, and that's going to hurt the stock market or be a reason for people to sell, which they feel like they do not have right at this moment.
Mike, on a day when Amazon's crossing $1,000 a share for the first time, and companies like Apple and Microsoft and Google are really stealing the limelight of the indexes, the major moves in these indexes are being represented by a very few amount of companies. How are you seeing the rest of the general equities performing? Are they really falling off compared to these major players?
Well, a lot of stocks are. If you look at the Dow components, for example, stocks like IBM have really crumbled over the past couple months. And the retail sector has had taken big hits. Biotech is now lagging. So there are pockets of substantial weakness in the stock market, but as a whole, most stocks are simply drifting around off their highs. If you look at something like UPS, it's off the high it's set in January, but it's not like crashing. It's just basically drifting around going sideways. And that's really more what I see. The problem is that's the same sort of thing that happened in 2015, where it was the Facebook, Amazon, Netflix, and Google that really were going up and everything else was languishing. And if those stocks then have a correction or pullback, usually the entire stock market tumbles too. So I think that's really what's ahead of us. Now, people want to buy and chase these things, and yeah, it's tough. I mean, you basically have to buy one of those stocks and put a stop loss order on it and move it up every week, and that's, I think, the best way to play it. And most likely, they'll continue to be strong until the July earnings quarter. And typically, what we're seeing are these stocks rally into earnings and then have some sort of dip afterwards. And if it's going to be a turning point dip, that'll be when you really want to get out. That's what happened actually in the summer of 2015. They all peaked out that July, and the NASDAQ went down something like 18% from that high in July to the low set in January 2016. So I think, some sort of correction is what's coming, but between now and probably the July earnings period, I don't see any signs of these stocks peaking out yet.
Mike, one sector that we're very, very keen on is the gold stocks, and they had that great rally January 2016 through August. Since then, there was the initial drop, a pullback, and then a bit of a trading sideways pattern that's now gone on for something like 10 months. What do you expect to happen with the gold stocks over the coming months, and how important is the performance of the general equities for the gold stocks?
When you say the latter, are you talking about how important are the gold stocks and their performance to gold, or with the S&P 500 in the broad market?
The S&P 500 in the broad market, a lot of people have said need to pull back for money to be available to really push gold higher. So I'm wondering if you agree with that point.
Well, in a general manner, that's not necessarily true from a historical perspective. I mean, there's no set rule that says, this month, if the stock market falls, gold is going to go up. Although sometimes that is the case. And since March, interestingly enough, the gold stocks have been trading a little bit opposite to the U.S. stock market. Now, obviously, they weren't doing that from February to last summer when both went up at the same time. So at this moment in time, it is true that they are sort of trading opposite, uncorrelated with the U.S. stock market. I do think in the big picture, it is important because I think what's really going to drive people into buying gold and gold stocks isn't necessarily the U.S. stock market, but a bigger picture of the Federal Reserve policy and the bond market, which tend to be tied to the U.S. stock market too. So let me explain what I mean by all this. Is right now we're in a tightening cycle with the Federal Reserve that started in December of in December of 2015. And next month, the Federal Reserve is going to raise interest rates again. Now, back in November, after the Trump election and that initial rally to the upside there, in which I was a buyer, I went and read about what Trump's economic advisors were saying in his transition team. And he had a group of people around him that were saying they wanted to see higher rates. They thought low rates and this quantitative easing was not really helping the economy. They're just making the stock market go up, doesn't really help the average person. I think those are all valid and true statements. Now, these people have faded in their importance. But at that time, the projections at the end of the year were that we were going to see up to 4 rate hikes this year. And to me, that was was good for bank stocks, but also was a bearish backdrop for gold. Because in the end, I think what will drive people into gold is a bear market in the bond market and looser monetary policy on the part of the Fed, which will lead to more inflation, and gold will actually go up ahead of the bad consequences of all this. So what's interesting is right now, yes, the Fed is set to raise next month, but the odds of them doing another rate hike after that are now 50% when they were much higher than that just a couple weeks ago. So what's changed is that two things. There was a little bout of weakness in the stock market a couple weeks ago when the Dow fell almost 400 points in a day. On that move, these odds in the Fed funds futures market shifted from having multiple rate hikes to really one, and a 50% chance of one in December. Now, today in the Wall Street Journal, there's a story out that said that the Fed is actually concerned of further stock market drops or volatility in the stock market, is the way they put it, that they don't want to see a repeat of what happened in August of 2015. And what they cited specifically was 2011, when the Fed tapered its quantitative easing program for bond purchases, and the market had a correction, and there's a couple of volatile months. They don't want that to happen, and they're scared. And what the story said is, therefore, what they are likely to do is do one more rate hike and then back off for the rest of the year. And instead of doing rate hikes, they will pare back on their repurchases of the securities they have, their holdings, pare back the balance sheet of bonds that they're owning by, when they hit their expiration dates, not buying them back and just letting them, kind of be liquidated, and do this in a slow manner. So at the next Fed meeting, they're likely to focus on that. And in reality, I think that's going to, on CNBC and the financial media, they'll focus on, they're paring back their balance sheet. And in fact, it's going to be a smokescreen in regards to the fact that they're actually lightening them up on their rate hikes, which will be bullish for gold. So the point of all this is to say that a few months ago in December, it looked as if we were going to have 4 rate hikes, many next year too. Now it looks like we may have one more left. So we're really reaching the end of this interest rate hiking cycle, which I think is a bullish reason to buy gold, to own gold. So in any bout of stock market weakness, will make them more dovish. We just saw that the other week when the market fell. So I see gold as a thing that, yes, it will benefit on any stock market dip, but the reason why is not because it's historically correlated to trade opposite to the stock market, because it really isn't, but because any dip in the stock market will frighten the Federal Reserve and make them more dovish on their interest rate policy, which is what I think is really going to drive gold up. And the consequences of all that will actually, the negative consequences of higher inflation, a lower dollar, may not even play out for years to come, but all these markets will move ahead of time, and gold is a safe haven for, this trap we're kind of in. And the fact that the Fed is so scared of any stock market dip at all, can't even see a 20% correction. That's what happened last year. We fell barely over 10%, and they had to do quantitative easing all over the globe. So, the thing about the stock market, it is that it's hard to think it's just going to go straight up like this week after week after week after week. And therefore, I think owning gold and mining stocks, just from these standpoints, I haven't even talked about the charts yet, makes a lot of sense to me, because there will be a dip at some point, even if the Federal Reserve doesn't want it to happen.
Well, we'll get to those charts in a second and some mining stocks you're interested in, but you bring up a very good point here, Mike. Most people are under the perception that the Fed's policy is going to remain the same. The Fed's not really mandated to worry about the stock market, yet we all know that a lot of the Fed policies are responsible for this bull market we've had in the stock market. In fact, if the stock market does see a dip, like you just said, of 10 or 15% as a result of one of these rate hikes, imagine what gold could do now that sentiment is much better than it was, say, a year and a half ago. If the Fed actually reverses policy and goes down a path of more QE or a reversal of one of these rate hikes, what do you think could happen then?
Oh, it would be completely explosive for the gold market. I mean, there's no doubt about it. And the thing about it is, to me, the move when right now, gold, I believe we actually started a bull market in gold last year, and we're in this long, drawn-out consolidation phase. And I've seen multiple phases like this since I started buying gold 15 years ago that can last 10 months or even 12 months. And when they happen, the mining stocks lag, which is what's been going on since last summer. If you plot out relative strength ratio of the mining stocks to gold. Now, I know there are people out there that see that and they think, well, that means gold's going to crash because the stocks tend to lead the action in both. However, these long consolidation periods, that's really not what happens. The gold stocks just lag. Gold doesn't crash. And I don't think it's going to, because there's not a big commercial short position. If you look at silver, in fact, the commercial's short position got lower for silver just the other week than it had been since the end of 2015. So, we don't have big short positions in these metals markets. Now, what happens though in these consolidation periods is that you just see this languishing action, which is one way to describe what's been going on. People kind of give up. People worry about big declines. And then all of a sudden you wake up one day and gold stocks are up 3%, 5%. Pretty good in a day, and they're outperforming. These relative strength ratios turn up, and you're just off to the races. And gold can be up 100 points in a week, too. And to me, I've seen that happen several times. And in the summer of 2013, there was a consolidation period that ended with a huge instant move like that. It just started with a bang. In 2007. A similar thing took place in which the gold stocks had been lagging for almost a year going into that August, and gold was trading sideways, and the stock market had a dip. In August of 2007, it fell almost 10% in like 2 weeks off of a high, and gold stocks dipped too during that drop very quickly, and then they reversed. And the relative strength ratio of gold stocks compared to gold turned up. And next thing you knew, they were making new 52-week highs within like 2 weeks. And they just outperformed the rest of the stock market for 12 months after that. And they actually outperformed the stock market so much that they attracted institutional money all over the world, including hedge fund money and all this hot money, because the stock market was just starting that terrible bear market. And I think that's kind of what we're headed for, a moment in which all of a sudden everyone's asleep, and then bam, gold stocks go up 10% or something in a week, and everyone starts to scramble to get into it, and the stock market no longer is going up at the way it's been, or it's even declining a little bit, and the momentum players chase whatever is going up the most, and so do trading robots. You've seen that in Bitcoin. We've seen that in marijuana stocks last year, the uranium sector, the bank stocks that I was buying. So we see how sectors go up when they become the hot thing. Well, if the stock market does just get a little bit of a correction of 5 or 10%, and you're going to see hot money flow into gold. But I think the situation that gold and gold stocks are in, that this is, the second year of a bull market after a long consolidation period. So the next move, could last much longer than the move of 2016 did.
Well, Mike, we've just got a couple minutes left here. When we've had you on the show before, you've talked about some junior companies that you're particularly keen on? Any companies that you're looking at these days and buying on the weakness?
Yes, definitely. And I think there's an important thing happening with the gold stocks too, that these individual companies are representative of. That's really important for people to know about. First of all, these exchange traded funds are dominating the activity of investors in the financial markets. There's the beginning of this year. There's been a literal mania of people going into exchange traded funds, and I was part of that myself by buying XLF, which became one of the most owned in the first quarter of this year. But in the mining stock world, so many people are focused on trading ETFs that they don't understand. They miss what's going on with the junior mining stocks, the individual stocks. And it's to their detriment. To give you an example, GDXJ is a junior mining stock ETF. JNUG is a triple ETF designed to track it. Well, JNUG is trading right on its December lows. It's a disaster. There's no other way to put it. In fact, if you look at where it is, it's trading below $17. The high was 130, split adjusted. It's had to have reverse splits. It's a complete disaster. And people in that are defeated because of the way they're suffering. And that is causing bearish sentiment to trickle out throughout the entire sector on message boards and so forth. And GDXJ, the ETF it's tracking, is having problems with it. The way it's designed, it's supposed to hold a certain class of junior mining stocks, not super small and not beyond a certain market cap, and they're having to change the rules of that because of how the sector went up last year. And make a long story short, I don't need to get into all the complications, but some stocks are having to be sold out of that ETF, and people are gaming that by selling them ahead of time or even shorting them, which is affecting JNUG again, causing a total mess. And what the point I'm trying to get at is so many people look at GDXJ or JNUG and they suffer and they think this is representative of the mining stocks, when in reality it's not. If you look at leading gold stocks such as Royal Gold, such as Agnico Eagle, they're breaking out already. The silver mining stocks such as Pan American Silver are doing fine. They're above their highs of a few months ago. And then if you look at junior mining stocks themselves that aren't in this ETF, because there are some junior mining stocks in GDXJ that are being hit and they're suffering because what's going on in that ETF. But stocks not in that ETF, they're consolidating. They're not falling. They're building nice bases, and they're in a position where if they turn up, and I think the sector has the potential to turn up around the next Federal Reserve meeting, especially if that turns out to be the last interest rate hike, which is the date's the middle of June. But these individual stocks are basically sitting there, not falling, consolidating. That puts them in position to potentially, as a whole, the junior mining stocks have small valuations because we're still so early in this bull market. Typically in a bull cycle, the average junior mining stock, whether it's an exploration stock or has developing a mine, but even if it's only exploration, they typically have market caps of 25 million. Now you can find ones of 5 million and 10 million that are even going to put mines in production. So to mention a couple names of these type of chart patterns, take a look at Wallbridge. The symbol is WM. Wallbridge Mining Company. It trades on the Toronto Stock Exchange. I own a position in it, but it's trading now with support at 8 cents and resistance around 11 cents, and it's developing mining properties. Another one that's a pure exploration play is Kruby Copper, symbol CUC, trading on the Venture Exchange, but it's got resistance at around 13 or so, support at 11, a very well defined trading range. IDM Mining is another one that's got a mine it's putting into production, support 14 cents, resistance around 17 cents. But the key is you look at any of these stocks, they're building strong bases. Now, if you go back to 2014 and the last bear market, what you would find is junior mining stocks across the board crumbling and falling and declining. Now, they weren't basing out like they are doing now. So I think that's a positive sign for the entire sector when you can find across the board stocks that are breaking out, some of the big caps, or stocks that are simply consolidating. And that's typical when you're in one of these drawn out consolidation periods within a bull market. That's what you should see. Now, if instead I was looking and finding stocks that are just crumbling that look like if GDX is what the typical mining stock actually looked like, or JNUG, then I'd be very scared of the sector. And I'd think, oh, this is just like the last bear market. We had a fake rally last year, and it's doomsday coming again. But that's not the case. Stocks across the board, when it comes to mining stocks, are consolidating. They look healthy. They look better than those ETFs do. So I think we're in, for an interesting summer with the potential breakout. I can't predict the future, with the markets, but I do think, we have a constructive possible pattern here. GDX, if you look at that ETF, it's right at $23. If it goes through the high of March, which is basically 25, then, we're going to be off to the races, just like the quick turnaround that happened in August 2007 and in the summer of 2003. And when that happens, you basically are going to see the stock market would probably, it would probably mean the stock market is correcting and so forth, and the volatility is returning. So that I think, we're in we have an interesting potential setup here, and we just have to see how things play out.
Mike, we're a little bit over time here, and I want to thank you so much for coming back on the show. We'll try to get back to doing this more often. Hopefully things pan out here for gold stocks in the next month or two. I have the same feeling that you do, that I'm seeing a lot of strength where it looks like weakness posted across the board. And just in our portfolio here at Palisade, we can see things are not as weak as you would anticipate from looking at something like the GDXJ. So I think good times are around the corner. A lot of negativity out there, and that usually is the time that sentiment flips on you and you get one of those breakout days. Once again, Mike is the publisher of wallstreetwindow.com. Definitely go to his site, check it out. He's got a free newsletter service and a premium paid service with individual stock picks. Mike, thanks for coming on the program.
Yeah, thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?